Okay, looks like we're recording too. Cool. All right. So what we were talking about just a minute ago was owning assets, but having entities, business entities, own the assets. And the reason that's important is because the IRS now allows us to treat those assets for business purposes, and that affects the way our tax liability is calculated. And this cannot be this can't be accomplished with just one structure. You need multiple structures. You need the right kind of structures. So I'm going to keep moving right along here. I kind of want to get to this next slide because it's one of my favorites. Recently, within the news, you have probably heard, um, and I'm not going to make this political by any means, but there's a lot of news talking about politicians self-dealing. And what that means is that politicians, and I'll tie this in with what we're talking about and why this is relevant here in just a second. But the reason that's important is because when a person is in a situation where they can deal something to themselves and benefit themselves, that's a conflict of interest. And so what we're seeing with politicians these days is it's kind of coming to light that potentially some politicians may have actually influenced taxpayer dollars going to organizations which they control. And that would be, you could call that self-dealing, you could call that related party transaction. In other words, the entity that the politician controls is being benefited by the actions of the politician and decisions of the politician themselves. Now, that causes a problem when we're trying to do tax strategy. So that's why we're on this screen right here. We're talking about related party transactions. And the way to make sure that the IRS does not treat your business as a related party is by structuring it properly and by having the correct documentation and contracts in place. So it's really critical to making the strategy work and making it compliant with tax code. So we're going to keep moving along here to this next slide, talking about hobby businesses. Now, a hobby business is going to be something that the IRS says this is purely just for tax strategy purposes. It isn't structured correctly. A hobby business might be, for example, I love to ride motorcycles. And if I created a business solely around me riding my motorcycle for fun, then the IRS is going to say, no, that's sort of a related party transaction. That's a self-dealing kind of thing. You're trying to create this business just purely for the tax strategy or tax benefits alone. And without the proper structuring, without the proper documentation and contracts that we talked about, that they're not going to allow that. And so what happens is potentially you take expenses related to the hobby business, they're going to disallow those expenses and deductions. That gets you into trouble. Now, on the other hand, a real business is going to have a profit motive. It's going to be holding meetings. It's going to be keeping minutes. There's going to have an operating agreement, all the documentation that we talked about that keeps us it keeps it separate from you as an individual, as the taxpayer. It creates this legitimate business operation. And if it's structured properly, then we can not only protect assets, but we can actually get the IRS deductions that we're looking for to minimize tax liability. So let's keep moving along here. And I'd love to get questions, but I think we're going to save those for the very end. So I'm just going to assume and hope that everybody's keeping up. Okay, let's bounce down here to this next one. So limited liability companies, a single member liability company, LLC, is going to be one person that owns that entity 100% by themselves. And with that structure, it does create some level of separation between an individual and a business, but it's not quite as much of a separation as we want. What we actually want is a multi-member LLC. This is also called a partnership. And the partnership that we create involves multiple people or another entity, specifically a trust, which we're going to talk about in a minute. But by separating out the structure of the LLC so that it's actually divvied up into uh, multiple levels of ownership, it separates the business itself from any one individual. And that creates that arm's length transaction and helps avoid the self-dealing aspect of the structuring. So, limited liability companies with multiple owners is critical. Okay, the next part the next part that I just referred to earlier, just a minute ago, was one of the partners in the LLC is going to be a trust. Now, there are two different types of trusts. There's revocable and irrevocable. Sometimes revocable is referred to as a living trust. And that means that you can make certain changes within that. And we're not going to be getting into estate planning as it relates to tax liability and that sort of thing. That's where revocable trusts really come into play. But with our particular strategy, we use a living trust, a revocable trust, sometimes referred to as a family trust. That creates another partner in the overall partnership. And that again creates that separation between the owners and the business entity itself, giving more validity to the business entity itself. So that's an important component in the overall strategy. Excuse me. Now, the purpose of all of this structuring is so that when we get to tax preparation and accounting, we start to look at the expenses that were incurred by this LLC. We're also going to be talking about a C corporation here in a minute because that's it's another leg in the tripod. And that's an important analogy here to look at. Whenever you're looking at this kind of a structure and strategy, you have to have the three elements or the three legs of the tripod. One's going to be an LLC, a multi-member or partnership LLC. The other one's going to be a trust, and the other one's going to be a C corporation. So the reason this is important is because now these expenses that used to be considered personal, we can now shift those over into a business environment, a legitimate business environment, and we can now deduct those expenses. So for example, generally all of us are going to have some kind of either a mortgage or a rent payment. We're going to have home office, utilities, maintenance, auto expenses, because another asset that we talk about in this strategy is actually moving vehicles into ownership of the LLC. And what that does is it now creates business expenses as opposed to personal expenses. And the business expenses now become deductible, taking away from our taxable income. So, still moving along here, I want to get into a couple things about the different types of expenses. Now, a moment ago, we were just looking at a screen that showed some operational expenses. And operational expenses is going to be a dollar for dollar deduction, which means that if I spend $100 on a utility bill, I get to deduct $100 on that utility bill. It's one for one. That's considered a cash expense. A non-cash expense is going to be something like depreciation. So when we had a home or we had a car or we had computers, furnishings, whatever it was, all these business assets that are fixed assets, when they are shifted over into the business, we get to actually depreciate those. And we don't need to get into how depreciation works exactly, but it's essentially there are certain formulas that the IRS allows so that when you take what's considered the life of the asset, the useful life of that asset, you divide it up into a certain number of years. For a home, it's 27 and a half years. For a car, it's probably going to be about 5 years or so. But there are certain formulas that the IRS allows and says, you now get to take the value of that asset, divide it by a certain number of years, And then that portion now becomes a deduction against your taxable income. So very important to understand how depreciation works, because that's a key component in the strategy. Now, earlier I mentioned the LLC. We talked about how this needs to be a multi-member or a partnership. We talked about how one of the partners is going to be the trust. And then we've also talked about, well, we haven't really talked much about C Corps, but C corporations are another leg in the tripod. So the C corporation generally is going to be, it's going to have some level of income, it's going to have some expenses, and then whatever profit is left over is going to transition or transfer over to the LLC, because the LLC is a management company offering management services and marketing, certain other services to the LLC. And if it's providing services to the LLC, I'm sorry, excuse me, it's providing services to the C corporation, that C corporation needs to pay for those services. So at the end of the fiscal year, and we'll talk about that in just a minute, at the end of the fiscal year, the C corporation is going to essentially pass the remaining profits onto the LLC. Now, let me back up a little bit, because it doesn't necessarily have to be at the end of the year. It actually can and should be happening throughout the year. But by the end of the fiscal year for the C corporation, we pretty much want to have very little or zero profit, somewhere right in there, maybe $1,000 profit or something in the C corporation. Because the C corporation, here's something important to understand, it's in its own tax bracket. The IRS considers it its own entity that has to pay its own taxes. So we want to minimize those taxes for the C corporation. We want to pass on pretty much whatever profits would have stayed in the C corporation. We want to pass that all the way through to the LLC. Once it gets to the LLC, we're going to be able to take more deductions, and then the remaining loss, generally what happens at the LLC level is we come up with a loss, and that's going to offset any other taxable income. Towards the very end of this, we're going to take a look at a spreadsheet, or basically a giant kind of calculator that shows how all this works, and it'll give an example. So we'll be able to see that here in just a moment. So this right here is kind of another slide that's actually showing how the corporation and the C corporation and the LLC, how they interact with each other as far as money being able to pass back and forth. Now, money passing from the LLC back into the C corporation is a possibility, but when that happens is not really part of this particular conversation. So we can get into that more in a one-on-one conversation sometime as we explore the strategy and application of the strategy for you personally. Okay. This right here sort of ties it all together. You've got your LLC right here, you've got your C corporation, you've got your trust, and then you've got the owners of the LLC. And so all of this sort of brings it together as far as how the structure works. And you can see here, the C corporation, this is public facing. Again, this is I referred to this a little bit earlier. The C corporation really isn't going to have too many assets. It's not going to have any profits, or a very small amount of profit at the end of the year. Something to note on this, C corporations, we structure it so that it does not own any assets. Now you notice right here, it's public facing, meaning it could be interacting with the public, meaning it's providing goods and services and that sort of thing. And if there was a situation where potentially there was some kind of litigation or lawsuit or something like that, we don't want people to be able to potentially sue the C corporation and get to the assets owned by the C corporation. So that's a sort of a layer of protection, because the C corporation doesn't own anything. The LLCs that work with the C corporation, that's where the assets are held. Okay, let me just shift over to one more screen here and hopefully kind of tie this all up. Sorry, I just need to, okay. All right, so what we're looking at here is a calculator that I built, which shows how the C corporation has a different fiscal year, meaning it doesn't necessarily start in January and end in December. It can start at the end of the first quarter, second quarter, third quarter. So it actually operates in a 12-month period that spans from one calendar year into the next. Now, understanding the importance of that is not really for this conversation. It really, we can get into that as we talk about how this applies specifically to your situation and managing the strategy as the year goes on. But what I wanted to show is that this kind of really is supposed to illustrate how the corporation, the LLC, and the personal taxes all work. The C corporation, again, pays its own taxes. So at the end of the year, we don't want any profit. Now, this potentially would be profit right here if we did not pass it all the way through to the LLC. What we do towards or throughout the fiscal year, maybe towards the end of the fiscal year, we make sure that this number is actually going to be closer to $1,000 or so at the most. The bulk of the profit is going to pass through to the LLC. And at the LLC level, we're going to be able to get operational and depreciation expenses. And with those expenses, we can oftentimes, because they're so high, because we've been able to transfer so many assets and now count so many things as business expenses that used to be personal, we are now able to generally find more expenses than what kind of top line income we have at the LLC level. What that means is that if you had $30,000 here, but you had $100,000 in expenses, you actually get a negative profit, which is a loss. And the way LLCs work is they pass through to your personal taxes in the form of a K-1. The K-1 now passes on $70,000 of loss to your personal taxes. Now, in this particular scenario, we're going to pretend like this particular client has $100,000 of W-2 income. It might be 1099 income, it could be W-2 income, but they have personal income over here. Now, without this strategy, this $100,000 would be fully taxable, except for standard deductions and other things that you can take. But that $100,000 is what your tax liability would be. It's what the IRS would look at to calculate your taxes. Because we have $70,000 of loss from the LLC that passes through to you personally, the $100,000 is reduced by $70,000. You now only have to worry about $30,000 of taxable income as opposed to $100,000. Now that's in this particular scenario. Every case is completely different. And obviously there are other types of variables that come into play. For example, child tax credits and earned income credits and that sort of thing. But the whole point is that we're going from C corporation income to LLC income. We get operational and depreciation expenses. We create a big loss, and that goes against whatever other taxable income you have. So I'm going to end with that right there. I know it was like sort of drinking from a fire hose. There was a lot of information pushed your way, but hopefully it made sense, and hopefully we can get into some personal conversations specifically about your situation and make this whole strategy work for you guys. So that's it. I guess if we're doing questions, I think it'll be towards the end. I think the plan now is probably turn the time over to Crystal and let her give you another fire hose bit of information coming at you.
Exactly what it's going to be. I'm going to cover both revocable and irrevocable, and I will fly. I presume that a lot of people do know a lot of this information, and so for the beginning, if you already know some of this, I apologize. It's going to be a little bit basic, but I just want to at least cover it for those of you who have not heard it before. So let me go ahead and share my screen. Let's see. All right, we're going to start with the basic revocable living trust. And I want you, can you guys see my screen?
Yes, we can.
Okay. We'll skip this. This is my why. This is my family. And so we'll move on to that. All right. So this is something that I give regularly for people who, again, have little to nothing, but I want to go through all of it for you. Now, when we're talking about revocable living trusts, we're really planning ahead for incapacity and death. So the things that we hope never happen is in the case of incapacity, and the thing we know will happen in the case of passing away. And so the biggest thing that we face with this is procrastination. I see this a lot in my business. We always tell people, hey, you know, if you're living and you're healthy and everything's going well and you're protecting your assets, a lot of time people don't think about, you know, what happens if someone becomes incapacitated or pass away, especially from organizational and asset protection perspectives. And so please don't procrastinate. When we're looking at estate planning, we're looking at 3 phases of life. Phase 1 is now. This is really what is going to apply when working with Pratt and LeFevre and all of the different organizational tools and asset protection tools they offer. The alive and well phase is really what we're in right now. You know, you're protecting assets, you're growing your estate, you're avoiding some of the liabilities, and people don't always think that you can enter the other 2 phases of life at any time. The other phase, the second phase, is incapacity. This means you're still alive, but you're no longer in control. So you cannot physically or mentally make decisions. So we need a certain set of documents for that phase of life. These are things like powers of attorney, financial, medical, you know, advanced directives, things like that. The other way to leave is the one that people usually think about when they want to come create a trust with me, and that is to pass away. That's a whole different set of documents. That's things like wills and trusts. Let's look at the incapacity documents briefly. Let me go back. So financial, medical, power of attorney, these are basically documents that say, if I am physically or mentally unable to make decisions, this is the person who has the power to make these decisions for me or to act on my behalf. They're important because we never know when this can happen. Usually incapacity happens suddenly. Death can be a little bit different. You know, we can pass away slowly or suddenly, but incapacity usually is pretty quick. You know, we don't often see it coming. And so it's very important to have these documents done in advance. We can talk a little bit more about what they do and whatnot. If you have questions, I believe that everyone has my email, so you can always email me or call me. The one that we're really going to focus on mostly is wills and trusts. Now, there is a difference between a will and a trust. A will, I describe it as essentially a document that says, here are my instructions. When I pass away, these are the instructions of who I want in charge, who I want to get my assets, and how they should get them. Okay. Wills do go through probate, so that's very important to know. A will goes through probate because it's a set of instructions. It's not an ownership mechanism. In order for people to retitle a house or retitle different assets, whether it's the bank or the county or another entity, the people that work at those places are not going to retitle an asset unless they have a piece of paper allowing them. The will is not sufficient for that. It has to be probated, meaning there has to be a stamp or an order from a judge, a probate court judge, that says, yes, this will is good. This will is probate is perfect. We're gonna, you know, distribute the assets exactly with the way the will says. That stamp comes from court. And so wills do end up going through the probate process, which not everyone knows. The difference between that and trust is a trust is an entirely different entity. A trust is a holding entity. It is an actual legal created entity under the laws, in this case of the state of Utah or whatever state you create a trust in. There is provisions in the statutes from the law that say you can create this holding entity called a trust. Its job is to take ownership of assets. And so you heard everyone talking, or you've probably spoken to people who talk about retitling assets to LLCs, retitling assets to get it out of your name, right? It's kind of the same thing. Trusts are very similar. You are the trustee of the trust unless you do an irrevocable trust, which we'll talk about in a minute. But before we get too complicated, the purpose of a revocable trust is organization. Asset protection is more the irrevocable trust. Organizational tool is the regular trust. The reason I think that this is important to know is that it doesn't provide liability protection on its own. So a basic revocable living trust is simply to say, we're going to put all the assets into the bucket, the trust bucket. We're going to title everything to it. And then when we pass away, the trustee steps in, the successor trustee, the person who's still alive that you put in charge. takes the assets out of that bucket and gives it in the ways in which you want it done to the people or entities that you want it given to. Okay, it's organization. It doesn't provide lawsuit protection. It doesn't provide any kind of tax protection. It doesn't provide anything. There's capital gains, but we can talk about that in a minute. So what I want you to take home about revocable living trusts: organizational tools, not protection mechanisms, and they're done for the purpose of distributing assets after death. Okay. And then the other thing I want to talk to you about is, sorry about that. Irrevocable trust. Let's get to this next one. I have a lot more pictures on this slide. Okay. So irrevocable trusts, important to know. Irrevocable trusts, I would highly recommend you meet with people at Pratt and LeFevre, you meet with me. Irrevocable trust, the type of trust that cannot be modified, amended, or revoked after its creation without the permission of the beneficiaries and the current trustees. You can change the trustees at any time, so you do have control in that way. But as far as changing the terms of the trust, which is going to hold assets if it's doing its job, you cannot change it, amend it, or revoke it at any time. So it is a big deal. For lack of a more fancy term, it's very important that you, before you decide to title an asset to this trust or to make an irrevocable trust own an asset, you got to make sure that the people that you put in charge are going to be the people that are going to work well with you, and that, if you did ever want to change it, they're not going to be the people that are saying, oh, you know what, no, we're not going to let you change it. We want to make sure that that you're thinking about it before you do it. It is asset protection, though, so it does offer liability protection immediately. The second you title a property to an irrevocable trust, it is automatically liability protected, which means if you get sued, the assets in your irrevocable trust are not subject. As long as you are not in charge and you're not the trustee on it, the assets in that irrevocable trust cannot be accessed. And so it's pretty big protection from a liability perspective. It also, from a Medicaid perspective, there is a seasoning period. So there is a 5-year waiting period for purposes of Medicaid. And what that means is, if someone ends up in a nursing home, for example, the first thing they're going to do is go through all of your liquid assets, and they're going to, because nursing homes are very, very expensive, they'll go through all the liquid assets, and when you can no longer pay anymore with those assets, they're going to slap a lien on your house, and they're going to spend through the value of the house in order to pay for your medical care. And in order to protect your home from Medicaid, you can put it in an irrevocable trust, but it has to be there for at least 5 years before. Okay, 5 years before the asset risk comes in. So before you go into the nursing home, before something happens. So these are definitely for Medicaid purposes. You want to think ahead. You're going to be thinking 5 years ahead. But once that 5-year seasoning period is closed, Medicaid cannot attach to that. So regardless of how much your medical expenses cost for nursing homes, Medicaid cannot attach to that. Okay. There are other types of irrevocable trusts besides the Medicaid Asset Protection Trust and a basic irrevocable trust. There's ILITs, which are life insurance trusts that holds life insurance policies to exclude them from the value of your estate for tax purposes. There's charitable remainder trusts. Those are the kinds that you want to leave things to charity, church, things like that. It also removes it from the taxable value of your estate. And then there's planning ones, which are special needs trusts. These ones are more for beneficiaries who have special needs or people who have special needs currently. The reason for these is that a lot of public benefits like Social Security, disability are dependent upon assets. And so if a person has a house or they have their assets, you can put them into a special needs trust so that they're not counted. And so that the person can still get whatever the asset-based benefit is without having their asset base asset them out, essentially, of eligibility. Reasons to do them, we talked a little bit about it. Asset protection from creditors and judgments, tax benefits, we went over that a little bit, and then control over distribution. So you don't have control over, once you put it in the irrevocable trust, over the trust itself, but you do still have beneficiary control. So you can still control, when beneficiaries receive assets and all of that, you can still provide financial guidance. Before I get too far ahead of myself, one thing I want to mention, because I mentioned before capital gains taxes. The reason I want to mention this is that oftentimes you'll hear people say, well, I will avoid probate by putting my kid on the deed to my house. We really don't want you to do that. The part of the reason we don't want to do it is asset protection, liability. If your kid hits somebody with their car, your house is up for grabs as something they can attach to in a lawsuit. Another reason is because when that person has ownership of that house with you, they also have your tax basis of what you paid for the house. For example, nowadays with property values being through the roof, 30 years ago, you might have paid $50,000 for a house, the house that you're in. It is probably worth $750,000 now. When they are titled on that deed while you're still living, they also get the $50,000 tax basis. So what happens when they're going to go sell it after you pass away at $750,000? They're going to pay capital gains taxes on that $700,000 growth. That's a huge tax bill. So a lot of people don't think about that. So it's, they want to shortcut and go around things like LLCs, like irrevocable trusts, like regular trusts. They want to kind of shortcut things, and there are things like that people don't know. So if you're ever talking to people or you're going to want to do it yourself, please don't put your kids on your house. Not a good thing. Okay. And the downside, obviously loss of control. You cannot just access it whenever you want. You can't just take things in and out if you're no longer the trustee. They are complex. Please consult with me or any other legal professional who is versed in irrevocable trusts. Please ask them how many they've done, and they'll talk to you about it. I've done probably over 100 irrevocable trusts in the last several years. Tax implications, consult with a CPA or an accountant or somebody who's qualified. Pratt and LeFevre can talk to you about tax implications. I'm not a tax attorney. You can also talk to a tax attorney. Okay. I think that I am over my time, so I apologize, but that's what I have. I appreciate you guys. And the questions will be at the end. I will be off, but if you want to shoot me, I will put my email in the chat if you guys have questions. Stop share. Okay, perfect.
Go ahead. Ravi,
Yes,
go
good
ahead.
morning.
Your
Good
turn.
morning. Good morning to everybody. And thank you for this opportunity today. And I just want to express that this is my first presentation I'm giving in my life. Let's put it that way. And thanks to you and Ron. And so uh, to start with, Brandon and Ms. Crystal has selected something that helps clients over a long term. And I have selected a subject which helps clients now rather than long term, because I thought it might be a better combination with two people dealing with the long term strategies and one of us leading with what helps clients now in this tax year. And let me see if I can share the document. Give me a minute if I can.
So how Ravi's getting everything put together, Ravi is a CPA and he lives in Texas. And he is the head of our tax planning department. He doesn't need to do a lot of sales, and so this is probably a new thing for him, but he understands our system really well. So I just want to say thank you to Ravi. But Ravi's still on mute. One of these days you'll get technologically savvy, right, Ravi?
Yeah, I'm not able to share my document, but allow me to be it as detailed as possible. But to the extent of the time that I have, basically the today's subject I have selected is basically two. One is the principles on business expense deduction, and the second one is a very rare section that is called section 280A of the IRC code, where it allows a taxpayer to use his home for business purposes and also get a deduction for it. And again, I want to caution, this is not business use of home or home office expenses. It is something different. So we will get to it in the next 5-10 minutes. So coming to the first principles of business expense deduction, uh, often every time we would always face a situation whether this expense is deductible or not, or how do we deduct these expenses, what is required to deduct this sort of expenses, those kind of questions we are always faced every day with the clients. So on that, the basic principles that govern a business expense deduction are basically four. It can be any expense, whatever expense you spend, that should be incurred in the tax year concerned where you want to deduct. That is one thing. Second thing is it should be related to the business. Like if it is a hotel business, it should be related to a hotel maintenance, or if it is an IT company, it should be related to a software expense or internet expense, those kind of expenses. And it should always also be incurred in the course of business. In other words, it should not be some out of the way expense that they are trying to bring it into the business. Though even though sometimes we document it in such a way that it is related to the business, but bottom line, we should be able to justify that expense which is related to the business, and it should be according to the business conventions of that particular industry. So as long as the expense satisfies these four conditions, we can deduct anything. Like they say, if you can document it, you can deduct it. That is the kind of principle that applies here, and it doesn't go by the name. You can name it any way you want, but it goes with the character of the expense. The as long as you're able to define and justify the character of the expense, name doesn't matter. So this is the broad principles that we apply when deciding whether an expense is deductible or not. Now coming to the second part of the presentation, which is basically a very rare section, which not many small business people use, which because they are not aware, and it is very popular among the high net worth business people. It's basically called a section. It is in section 280A of the IR of the Internal Revenue Code. What it basically says is whenever you use your home for a business gathering, that is for less than 14 days in a year. Basically, I would say maybe uh, 3 days, 3 days in a quarter, that comes to around 12 days in a quarter, 12 days in a year. So approximately around 14 days and less in a year. If you use your house or home for your business purposes, mainly for something like business gatherings or business meetings, something like that, you can deduct an amount equal to the fair market value of your home for that particular 2 to 3 days of rental that qualifies. Basically, to put it in a more clear example, if when you want to conduct some kind of a business gathering or a business board meeting in your home, which regularly for your partners, or if you want to host your business associates in your home for continuously 1 or 2 days in discussing business with them, you can use this provision to gain some gain some good business expense. Basically, when you check with other hotels where you can to host this kind of a meeting or to host this kind of a person in a restaurant there, uh, and it costs you, let's say, $500 a day. So for 2 days, $1,000 a day, you can charge your business and invoice the business for this expense and get it reimbursed. And the second part of this deduction is the income that is received by the taxpayer, that is the owner, is not taxable. It's a tax exempt item. If as long as the rental is received for less than 14 days in a year. So, in other words, for 2 days per quarter, if you are charging the company $1,000, And for 4 quarters, it will be $4,000. So $4,000 is a tax-free income to you, while it is a business expense for for the company. Or the only exception to this is this doesn't apply if your company if your company or business is an S corporation. It will apply if you are a partnership, it will apply if you are a C corp, but not if you are a S corp. The reason they have not included S corp in it is that S corps are subject to reasonable compensation rules, and any income received by the S corporation shareholder is also subject to Social Security taxes, which is the reason it is not exempt. S corporation is not included in this. So to summarize, this is a great provision for most of our clients because since we form all our companies as a C corp, the business, and this will give them, depending on the house they use, depending on the market value of their house, depending on the space they use for this kind of gatherings, it will give them a good business deduction, while also it gives them a good tax-free income. And one of the most important condition that we need to advise on the taxpayers is to have a separate place in the home to conduct these kind of meetings, like because since this is not a home office deduction where we use only 150 square feet or 200 square feet of the home, this applies to a portion of the house where the taxpayer can use like something like a meeting kind of place, or um, organize some sort of a retreat in the house for all the partners, something like that. Maybe if he has a farmhouse somewhere which is being used as a second home, that will be a right place for him to apply this deduction. So these are the two things I thought if I will bring it into bring it here today, and I will share the presentation with the firm as soon as this meeting is done, and I can and now the floor is to Mr. Ron for recapping the whole meeting.
Years. I've been married for 46 years.
Okay, you just unmuted, so now go ahead and start.
Right. I said, it's my turn now, I guess, Ravi. Sorry.
Yep.
And I said, I guess I get the last word in, but I've been married for 46 years, and in 46 years, I've never gotten the last word in. See, that's the problem with everybody being muted. I don't hear anybody laughing. Maybe the wives don't think it's funny. I don't know.
Maybe no one is.
Could be very, very much.
We got you laughing. So
Well, my wife doesn't even think I'm funny, so that's okay. I understand that well. I'm grateful that she still puts up with me after all of these years, right? Oh, there's Patty Campbell down there on the bottom. Patty, I love that lady. There's some ladies here that I've known and I've worked with. Anna Chan and I have worked with now for a couple of years, and Patty Campbell is just a sweetheart. She's a great lady, and I'm going to tell you right now that Crystal Flynn is probably one of the best attorneys that I've ever worked with as far as knowing estates and business, and she's easy to work with. So for the rest of you, I hope to get to know you really well. I know everybody here. That's really interesting. It's really good. Johnny Barker, for instance, is a good friend of my third son and went to high school together. And I've helped him over the years many times. And so it's nice to have him here as well. Anyway, let's get back into I can share my screen right now. Can I?
yes, you can. Go ahead. Let's get going.
All right. So I'm going to share my screen real quick. And you've seen many of these slides already. But it's necessary to repeat them. Okay. So I'm going to leave this off to the side because I'm not going to necessarily go slide by slide. Okay, let's put this up here. There we go. I got to get these little bars out of the way so that I can see what I'm doing. Going blind in one eye and can't see out of the other one, right? All right, so You saw this before when Brandon was talking to you about it. It's called the once cash flow strategy. Whatever you own can be taken. We don't want that to happen. We want you to control everything and the structure and how to control. Crystal touched on this a lot, right? Irrevocable trust, you lose control. Living trust, revocable trusts, you don't. You keep control. But as Crystal said, revocable trusts don't protect the assets. We can talk about that a little later. Here is our organization now. And this is just our let's see if I can get that out of the way so everybody can see it. Okay, good. Okay. This is our management staff all over the United States. We have others in here that I just couldn't fit on here. So these are the people that work with us. We've been in business for, in March 20th is our 17th anniversary. And we've done a lot. We've been able to help a lot of new businesses. I personally have been involved in the development and teaching and operations of 4,000 plus businesses. That's what we want to work on. Okay. Now, this is a lot of our certifications, people that we work with that we are a part of. Okay. We want to be able to help others. We also, and I don't have this up here, we also belong to the American Institute of Certified Public Accountants, AICPAs. That's one of the most famous ones. Okay. Now, why was it you guys decided to go into business for yourself? Most of them say independence and autonomy. That's absolutely correct, right? But I'm sure you wanted to make more money. You thought more that you could control your money than anybody else, right? Most of the reasons that people go into business are not because of reducing tax liability. It's because most people don't even think about that. And how about protecting you and your family and your assets? As Brandon talked about, and is the protection is because of related party rules, and you've got to be really careful. But most companies don't know the difference. Laurel Langemeyer, and she's written several books out there, and I've gone to a couple of her seminars, say if you want to be a millionaire, act like one. Most millionaires have multiple companies, multiple corporations and trusts and LLCs and charities and all of those. You can work all of those together, but you have to do that, okay? But what you're going to do is you've got to make it so that they don't see all of the layers, and each layer has to be independent and separate. This is what I look like when I'm on the slopes. I used to be a staff accountant for one of the Park City resorts up here in Utah. We have 10 resorts within where I live, within an hour of where I live. But I was a staff accountant up there until they sold the business to another larger company. So they brought, of course, in their own company. Here's the different kinds of businesses. Here's the different things together, right? You remember what, see if I can figure out where I'm at here. I was looking for a specific slide. Well, anyway, Brandon showed you a chart that shows the different companies that they have to work together. You can't just have one to make sure that you are protected. You can't have just one to make sure you maximize your tax benefits. For your information, and we've done a deep research into this, as Robbie was pointing out, there are 23 tax disadvantages for S corporations. You can change it, and that's easy to be done, but you don't. And what we've tried to recommend is that most corporations don't use S corporations. S corporations were put into place in 1959 in order to help the taxpayer, the business owner, reduce taxes, because the biggest cost was self-employment tax. That's the main advantage S corporations have, is there's no self-employment tax. But you have to pay yourself a W-2 wage. You can't have your children working for you. There's a whole bunch of different things. C corporations are taxed different than S corporations are. C corporations, and we'll go through that in a little bit, pay their own tax. But C corporations have advantages and disadvantages. Every structure does. And limited liability companies down here also have advantages and disadvantages. And what we're going to show you is how to take those companies, those two different structures, and let the C corporation overcome the disadvantages of the LLC, and the LLC's advantages will overcome the disadvantages. So you get the most of the C corporation. You get the best of both worlds. And you also want to add in a DBA for control purposes, but that's how you get paid. So how do you remember, how do you not have to pay a lot of self-employment tax? Because sole proprietorships, you pay self-employment tax. And the trust is there strictly for control. And if something happens to you as the entrepreneur, you and your spouse, if you're married, or both of you at the same time, that trust can take over the business and elect the partners and the people that are going to go in that company to run it for the benefit of your family, who are your beneficiaries, without probate. Wills have to be probated. Trusts do not. And that's what Crystal was trying to explain to you. But the question is, for you guys, which one do you want? Do you want them all? Do you want just one? How do you get that? How do you know? Just remember this. Usually when I'm giving these seminars, I get to talk to people in between. So that's one of the reasons that webinars are kind of difficult for me. But do you know what the KISS principle is? Don't forget the KISS principle. And it stands for keep it simple, stupid. My wife won't let me tell anybody that they're stupid, so I say keep it stupidly simple. Make it easy to start the business, easy to manage the business. But if somebody comes after you, easy to walk away without losing anything and just shut the company down and start all over again. That's one of the reasons why we do it through the skiing, right? One outside jacket there. That outside jacket protects everything underneath it. But the outside jacket can be disposed of easily. If I fall down the mountain and I bump into a tree and a big hole's been ripped in my jacket because of the tree, some branch sticking a tree in me or a branch in me, I'm not going to try to fix it because it's still blemished. I'm going to go down to the bottom of the hill as fast as I can get there without freezing my butt. I'm going to take the coat off. I'm going to put a new one on in its place. I'm going to discard the old one, and I'm going to go up to the top of the hill and start all over again. You use these organizations to help you, to protect you, and to maximize your tax benefits. Most entrepreneurs don't do it that way. Most entrepreneurs, they start the business, they call themselves a single or an LLC, but that's starting with the roof first when you're building, and you never do that. You've got to have a support system. And what we're doing is helping you build a support system, right? That's what we want you to do. So this is the organization, as Brandon showed you, of how we suggest it. The C corporation is your outside coat. The LLC is your underneath layer, and you don't need a whole bunch of them. You can if you want to, but the difference is the related party rules. If you remember what Brandon said, there's related party rules. There has to be separateness. There has to be independence. When you are part of the family trust, as the beneficiaries, or not the beneficiaries, of the trustees of the trust, and you manage the trust, you are the trust. You are not you. You've got to get that separated out in your head, right? When you are in the C corporation, you are an officer or a board member. You are not you. You wear different hats. You act in behalf of and for the C corporation. When you are part of the LLC, you are the LLC, not you. And the thing that makes it work is keeping each entity separate. Ravi gave you some ideas of how to be able to use your home. And I'm going to show you a few more ideas here in just a minute. But at the same time, you've got to follow the formalities. That's what keeps you safe. The trust is the trust, and the trust elects the board of directors and makes minutes of it and keeps minutes and records. The corporation has two big organizations. One is the board members, and the other one is the officers. Right? The chairman of the board, for instance, is not an officer's position; it's strictly a board position. Then you have two officers. And one of you will be the CEO, one of you will be the president and chief operations officer, the other one will be the secretary. We want you to have three. But when you're in those positions, you are not you. You are the corporation. And then the LLC, and the only obligation legally and that it has, the only legal publicly visible thing is the corporation, because the LLC has no public liability. All it has is the ability to work with the C corporation, and the only thing that allows them to do that is not just moving money wherever you want to, it's contracts, it's formalities, it's being separate. And then your DBA, your sole proprietorship, makes money from the LLC, not the corporation. You are not to be paid a W-2 wage, okay? C corporations is all about taxes. S corporations, right, have different abilities to do things. C corporations are more flexible. When they did S corporations back in 1959, they were more flexible. They could do things more, okay? Requirements for maintaining corporate status, for its separateness, for the independence, is the shareholders elect the board and keep minutes. Policies and procedures are set by the board of directors, and the bylaws are also, right? And they make the difference. They have to keep them. And they elect the officers. They have meetings, and we recommend at least once every 3 months. Officers then manage the company. They implement the board's policies and procedures, okay? But when they do it, they are the company. The corporation must act as a corporation, not an alter ego. In other words, if you don't follow the procedures, if you don't keep the minutes, if you don't have the contracts and follow it, the IRS likes paper. If you don't use the formalities, the law and the IRS considers you an alter ego. You have no protection. They can bust the corporation, okay? And you must have regular meetings. Now, let's talk about limited liability companies. Limited liability companies are good if, see this one right here in the front? He's got his own company, but he's a single member LLC. He can't separate himself from the business. He cannot have meetings with himself. He can't do all of that stuff, right? You need to keep the separateness. So that's why we recommend the LLC, because if you are a sole member LLC, a single member LLC, the IRS considers you a sole proprietor, and the money you make, you pay the taxes on, and the LLC gives you no protection because you can't separate yourself. The law gives you no protection, and a single member LLC considers you a sole proprietor and can take all your assets if you ever have a lawsuit. On the other hand, multi-member LLCs pay the tax based on the percentage of ownership. And you can meet, all of you, at one time or another to do it. LLC by law is only required to meet once a year. But after that, you need to have regular meetings. The once a year one is just to elect officers. And no matter what the people say, you don't need a president in the LLC. You don't need a chairman of the board because you don't have a board. The owners are called members. And the members are the ones that meet and have member meetings. And you can have one of two different managers in place. You can have what's called a managing member. That's the one that I'm always arguing with banks about, because they say that everybody that's a manager has to be a managing member. Not true. Managing members are one type of manager, because they're the members that are the managers. And then you can also have a general manager. Most of the time, general managers are not members of the LLC. They're not owners, they're outside individuals. That's not required if you're a general manager, but you can also be a general manager. So what we do, especially with husband and wife, one of you is the general manager, one of you is the managing member. Now, sole proprietorships, right? You're all by yourself. What is the risk, right? You're open for business, but you assume all of the risk, and the money you make is taxed as self-employment tax, and that is higher than regular tax. Self-employment tax also includes Social Security and other taxable things that you have to pay by yourself. So what we want to do is have you look at yourself as though you're a box. You do business, money comes into the box. You pay expenses, money comes out of the box. Corporations are self-contained. The owners or the owners and the shareholders are just shareholders. They don't pay tax on what the profits are. Okay, but if the corporation pays the shareholders, and the shareholders, if you remember, are the trust itself. Okay, let's see if I go back to over here. The trust is the only shareholder of the corporation. They don't pay tax on the profits, but they're usually there to make a profit themselves. And so the corporation, out of the profits of the corporation, pay them a dividend. And the corporations then pay the tax on the rest of it, including the money for the dividend. That's why you hear double taxation. Double taxation is, in fact, double taxation if the corporation pays dividends, then the shareholders have to pay tax on that dividend. The corporation does not get to deduct the dividend as a tax maneuver, tax reduction. They have to pay tax also on the full profit, including the dividend portion. That's why they call it double taxation. On the other hand, sole proprietorships, the money comes in, the money goes out. If there's money left in the box as profit, that is passed through based on the individual member's ownership percentage. And those individual ownership pays the tax. You as an individual pay the tax on that, okay? Now, we want to change that. We want to make your home assets. Remember what Brandon was talking to you about, and Ravi as well, different ways you can reduce your taxes by using your home. The asset definition from an accounting point of view is an asset that's an economic resource. In other words, the asset helps produce income for the business. And remember, you've got to have separate things. So now you can take your whole house, not based on certain percentage over the years, but you can deduct all of the expenses on your entire house, because your entire house is going to rent to the corporation. Let's go back over here. The LLC is going to own the house. It's going to have a contract with the corporation that pays a decided rent, a contracted rent for the house to use an office in the home. And the office is fully furnished. Then you and your wife are also, because you're living in the house, going to pay a rent. So now the corporation's paying rent, you're paying rent, and the corporation or the LLC has the ownership rights to the home. So now because of that, it does not become an investment, it becomes business. It is a business asset that generates regular, ordinary income for the LLC, right? Then take your home office deduction because of that. Most times, and Ravi alluded to it a little bit, that you don't have to do just an office in your home. Most accountants require that if you have business there and you have an office, it has to be designated as an office. Excuse me. And it only gets to write off whatever your square footage space is for the house, of the house for your home office. That's all you get to do for depreciation, for all of the expenses that go with it. And what we're telling you is, let's not do it there. What if we could use your entire house as an income producing asset for the LLC? It now becomes 100% tax deductible, right? So you're not using just one structure. You are using two of them together. Your corporation is a renter, you are a renter, and the rental house includes all assets, all furniture, fully furnished, and all expenses paid. So now the LLC gets to pay for all of the expenses out of the home, okay? Utilities, insurance, maintenance, repairs, everything, right? Now, these are your common expenses. These fixed expenses can now be 100% tax deductible, what you normally can't do. That means that we're going to be able to reduce your taxable income by 70 to 80%. Okay. And not only doing that, but it's also legal and ethical, correct? And the way we do that is we have contracts between the LLC and the corporation. And the corporation has 3 contracts with the LLC: the home rental, the automobile and equipment rental, and a management and marketing agreement. So if there's money left over in the corporation so that it doesn't have to pay a lot of tax, have it pay it to the LLC. But corporations are taxed on a fiscal year. And if you don't know what that is, a fiscal year means that your corporation's tax year can start anywhere in the beginning of a calendar year and end 12 months later. But LLCs have to be, in rare circumstances, it can be otherwise, but most time, 99.9% of the time, they have to be taxed on a calendar year, January through December, because you are taxed on a calendar year, what you make and what you expend, okay? So that's what we want you to be able to do, is to move the company money from one entity to another. Remember, own nothing, control everything. The other thing you want to control is money. So if there's money left over in the box after you paid your expenses, how do you get rid of the money in the box and yet you keep in control of it? It's by the contracts. It's by the ability to pay the other company, okay? And you can also hire your children. When I was growing up, and we had 9 children, my wife and I, and at that time they allowed us to do only $3,000. Today you can do $12,500 per child. But as Ravi said, C corporations cannot, S corporations cannot. They have to be a family-owned business. So your LLC that owns your assets and rents them to the corporation and to you can work for that LLC and do things that are regular to do. Now, the kids have to be old enough to do that. Otherwise, you get just a child tax credit. If they're 2, 3, or 4, or 5 years old, it's kind of hard for them to get to do it. Maybe when they're 5 or 6 or 7, they can start doing things. For instance, because your LLC owns your house, have them clean the garage and pay them. You can pay those things, and as taught to me by another tax attorney, you can pay them up to that amount every year, give them $100 or $200 a month, and put it into their personal savings account so that they've got something to spend. They're going to think that they're in seventh heaven. Take half of the rest of it, set them up an IRA or some sort of a savings account that can then be taken out tax-free when they're older to go to college. So that's their college plan. And then take the other amount and charge them room and board. You can put that in your pocket, and you don't have to show it as income, and it's an expense to the LLC. Okay. So what we want you to do is to understand this, right? It says, can you sum up this year's budget with one word? Help. I can understand that really well, right? And this guy over here trying to get in when it says pull, you're right. Not to be blunt, but trying to, you're just not very sharp, are you? Right? In other words, he's trying to keep him on the track, but there's no point. And that's what we want you to be able to do, the same thing. Okay. Remember, you've got to have a plan of action. You can't just think it. You've got to do it. You have to follow the formalities. So, Boyd, I think my time is up, but I'm going to tell you a story. And just remember this. There was an old farmer. He'd had his house passed on to him, his farm passed on to him for years, down from generation to generation. He was the last of his generation, nobody to pass it on to. And so he tried to sell the farm. He went out and fixed up everything, fixed up the orchards, fixed up the old barn, tried to sell everything, but nobody would buy the farm. And he couldn't figure that out. Well, he found out later on that it was because he had a donkey. It was just an old donkey. Nobody wanted the donkey, and the well on the farm was dry. All right, he said, I don't know what I'm going to do. And he just kind of thought about it for a little while until one day the donkey fell into the well. He said, oh, good. We'll just take care of both of these things at the same time. Called all of his friends in, and handed them shovels, and they started throwing dirt into the well. Well, the donkey was old, but he wasn't stupid. He knew exactly what was happening. Boy, he put up a fuss, kicking the walls and braying and all those other things, but it didn't last long. It ended really quickly, and the farmer said, that's really unusual. I can't figure it out. So he goes and looks in the well. As a shovel full of dirt got thrown in, landed on the donkey's back. Donkey just shook it off, and stepped up. Another shovel full of dirt, shook it off, stepped up. Another one, shook it off, stepped up. 2 hours later, the old donkey walked out of the well. Moral of the story, you guys are self-employed. You are entrepreneurs. You're used to it. Life will throw dirt on you. Just shake it off and step up. But there's also another story, about moral to the story. The donkey was old, yes, but he wasn't stupid. He knew exactly what the farmer had done. He went out and tried to find the farmer, and found him, bit him on the behind just as hard as he could bite. The bite became infected. The old farmer died. Moral of the story, if you make a mistake and try to cover your ass, it's going to come back to bite you in the end. Thanks, Boyd.
All right, thank you. And we're all done with this, so I'm going to stop the recording. If anyone has any questions at this point,